Hello and welcome to the October Resource Consumption Accounting Institute webinar and discussion. Today we'll be discussing identifying avoidable costs using RCA. As always, this webinar is being recorded, and when I end the presentation part and start the discussion and question part, I will turn off the recording. If you have any questions or discussion items, you're welcome to use the chat feature. However, I won't be able to look at it until after I finish the presentation. So please feel free to use it, but don't expect an immediate response. So let's get started. I always start with this slide about resource consumption accounting. For those of you that aren't that familiar with it or are attending your first RCA Institute event, RCA is a combination of German management accounting methods, often known as GPK or Grenzplan Kostenrechnen in German. Pardon my presentation if you speak German, my pronunciation if you speak German, and activity-based costing. Now, if you're not familiar with GPK, that's understandable. Not much of it has been translated into English. It's in wide use in Germany. Now, the focus of RCA is internal management decision making, not financial reporting. Its focus is linking operational metrics to finance in a meaningful, economically realistic way that goes well beyond the requirements of external financial reporting. And to do that, it maintains clear cause and effect relationships. So this is the IMA's conceptual framework for managerial costing. And RCA is the best costing approach to implement the IMA's conceptual framework for managerial costing, which is methodologically neutral, but tries to present the elements, create a framework for creating financial information for internal decision support. The framework, if you're not particularly familiar with it, has two principles. The first is causality for modeling. The second is analogy for information use or decision making. The idea is that you create an operational model of the organization with the flow of resources throughout the processes of the organization, and then you create a costing methodology to reflect the characteristics of those resources. That forms your baseline information for optimization. Now, there are a variety of concepts that support these two principles, and they're shown here. So we have modeling concepts, and we have concepts for information use. What we're focusing on today is the concept, the information use concept of avoidability, which I've highlighted. Now, avoidability is also fairly closely related to another concept called divisibility that we will discuss to some extent. There's also relevant constraints. Of course, information only has a value to a certain point, and beyond that, it becomes trivial. And there are other implications and constraints that keep a model from being perfect, and those are captured by the constraints categories. So, what is avoidability from the conceptual framework for managerial costing? It's a characteristic of an input that allows for that input, and hence its cost, because remember, we do operational modeling first, to be eliminated as a result of a decision. The key points are, its avoidability is really a characteristic of a resource, not a cost. As many of you have perhaps heard me say before, the source of all costs is resources. The other key point is that avoidability happens as the result of a decision. In other words, the status quo has to change or there will be no avoidability. And another question that comes up is, what about time? There's a lot of discussion in costing sometimes about long-term costs and short-term costs. And if you noticed the conceptual framework a few slides ago, time was never considered. And that's because we all know that the long term and the short term are really about decision making and decision implementation. And we didn't consider that to be a fundamental concept or principle that has too many elements of human, what should I say, intent or commitment. So we don't exactly deal with long-term and short-term because we're dealing with reflecting what's there, or plan, and in some cases planning for what may be, but the time it takes to make a decision is an entirely different matter. The other concept I mentioned, and I just want to mention quickly, is divisibility. The definition of divisibility is a characteristic of a resource that allows it to be associated in its entirety with the change in a managerial objectives output resulting from a decision. So this is the idea that if you have perhaps a highly technical maintenance employee, and that you get rid of, say, half the equipment that maintenance employee does maintenance on, so you cut the job requirement essentially by half. If that technician is critical and hard to hire, you won't save any money at all on that technician because you need to keep that technician employed. You may be able to find new work for that technician to do or alternative work, but the core reason you hired him, there won't be any savings associated with getting rid of half of that equipment. So that's just a very common sense thing, but something that is sometimes overlooked, particularly when you're dealing with a purely activity model and you don't go back and look at the baseline resources. There can be an assumption that there's savings when in fact, if you don't eliminate a resource, there are likely no cash savings. So now I want to talk about some cost concepts. The first concept is the idea of decision support. And the decision support concept is that a concept that a cost is either avoidable or unavoidable. And that's really what you're making decisions about, is avoidability. The second concept is what is called the operational concept. And that says that a cost is fixed in relationship to a particular output or variable with relationship to a particular output. Now, these two concepts often get confused, and I'll talk about that on the next slide. There's this idea of a relevant range. that kind of tends to confuse variability and avoidability. I would suggest you just purge that idea from your thinking. The real issue I want to get to is which cost concept must form the basis for cost modeling. And I would argue that you can't model decision support, avoidability or unavoidability, because there is just an infinite variety of decisions that could possibly be made. So you can't tag every resource or every activity in your organization as avoidable or unavoidable, because it depends on the nature of the decision. However, you can model the operational concept between a resource and its direct output. So that's what RCA does. We do model the operational concept and use it as the basis for action in applying it to decision support. And a lot of that depends on the granularity you get to in your modeling, which of course is based on the type of decisions that your organization typically needs to make. So one of the terminology has been used in literature called the blended cost concept error. And that's common when you mix up the operational concept and the decision support concept. The blended cost concept error is defined as fixed costs are not the same as avoidable costs, and variable costs are not the same as avoidable costs. I think I said that wrong. Fixed costs are not the same as unavoidable costs, and variable costs are not the same as avoidable costs. So let's look at some examples just to kind of drive this point home. So example one, you have a manufacturing company and it decides to replace an old extrusion line with modern equipment. This results in a significant reduction in the amount of maintenance required. The maintenance manager realizes that he can reduce his total maintenance capacity by 8,000 technician hours, the equivalent of a whole crew, including the crew supervisor. The question for this scenario is, what are the respective operational and decision cost concepts for each of the technician wages and the supervisor salary? Well, let's take a look at it. The operational concept is the operational cost characteristics of technicians' wages is that they are a variable cost. The operational concept of the supervisor salary is that it's a fixed cost because it doesn't vary with the amount of maintenance. The technician wages or the technician activity does vary with the amount of wages, and it goes from either being fully used time or perhaps idle or standby time. The decision support concept, is that both technician wages and supervisor salary are avoidable costs in this scenario. So in this case, operationally fixed and variable costs can be avoided because of the equipment change. Let's look at a second example. The same company receives an offer from an outside vendor to take over the maintenance and repair of extrusion rollers. The manager knows from his RCA system that the company spends 2,400 hours per year on these activities. A maintenance technician works 1,600 productive hours per year. What are the respective operational and decision cost concepts for each of the technician wages and supervisor salary in example 2? So the operational concept are the same as example 1. The technician wages are variable and the supervisor's salary is fixed. The decision support concept is that the wages of one technician, the first 1,600 hours, are avoidable. The costs associated with the remaining 800 hours, half of a technician's productive time, are unavoidable. And while the crew supervisor is maybe less busy with less employees, his salary is similarly unavoidable. So in this case, we still have a situation where operationally fixed and variable costs are unavoidable. In the last scenario, they were both avoidable. So the blended cost concept error is committed by using operational cost concepts, that is fixed and variable, in decision support analysis. The error has two effects. It overstates the benefit of a decision when some variable costs are unavoidable, and it understates the benefit of a decision when some fixed costs are avoidable. Now, resource consumption accounting focuses on modeling resources. So operational characteristics are in the forefront. Remember the idea from the conceptual framework, an operational model that is costed. Resources are often chunky. You may think you're going to save some resources, but unless you save a particular amount, you really don't save or eliminate a resource. On the flip side of that, dollars are highly divisible. So there's a tendency, if you're just modeling dollars and not looking back and matching these carefully to resources, that you'll think the dollars can be avoided. RCA also models and traces fixed and proportional consumption. Proportional means variable. For simplistic purposes, I could go into a deeper explanation of the difference, but for the purposes of this discussion, we can consider them the same. So RCA has a big focus on modeling fixed and proportional consumption, from resource center to resource center, from intermediate to intermediate managerial objectives and to final managerial objectives. In other words, it follows the nature of resources as fixed and proportional throughout the processes of a company. RCA also models the changing nature of consumption and as it moves through a value chain. So just because a resource is variable at one point doesn't mean by the time you're considering it as an input for a final product that it's still variable. It may have become fixed due to the nature of the process. I'm not going to go into that right now. That's a bit of a discussion for another day, but I guess if you have questions, I'll be happy to field those when we get to that point, which is soon. Okay, so this is just a diagram I like. It was put together some while ago by the International Federation of Accountants. It was kind of a costing maturity continuum. And what it shows is traditional standard costing, activity costing, and finally resource consumption accounting, with the highest level being full real-time simulation. This is not a progressive journey. You can jump in at any point in time. One can argue that resource consumption accounting has some elements of both activity-based costing and traditional standard costing in it, but it applies and models purely for internal decision support based on an operational model. So I hope I've given you some insight into the nature of avoidability and what RCA does to identify as comprehensively as possible avoidability and unavoidability, as well as some of the philosophy that RCA applies as it models and looks at the organization. I'm going to stop recording now, and I'll open it up for questions and comments.